as they wish. Good morning, everybody. I'm Ron Zarek. I am with the Silicon Valley Capital Club on the board and the chair of the Business Forward Council. I'm also a proud employee of Petrinovich Pugh & Company. Welcome to our first Capital Connections webinar, and that's on behalf of the Board of Governors and the Business Forward Council. We, of course, hope you and your loved ones and colleagues are healthy and adjusting to this temporary new normal. And this is, as you can tell, a very different program from our usual Capital Connection breakfast events. But web meetings and webinars are becoming really the way to go these days, and it seems to be the only way to get together other than with those you live with. So here we are. Thanks to the Business Forward Council for organizing this event, and our plan is to organize more of these type of webinars in the future in lieu of our in-person events that we do at the Capital Club until such time as we can all get together again. Usually I announce all the things that are going on at the Capital Club at the beginning of the program, but frankly, right now there isn't much going on. Look for your emails for those online events that the club is holding, but I don't have any to announce right now. Before I introduce our speaker, I want to thank Sarah Lynn Winslow of Petrinovich Pugh & Company. She's our marketing director, and she is responsible for the wonderful PowerPoint content that Tom is going to deliver to us today. And Sean Scudellari is with our PP&Co Technology Group, and they have been busy, as you can imagine, with all of us working from afar, and we thank him for tech support. Our speaker is Tom Wagstaff. He's the senior tax partner at PP&Co, and in spite of Tom's youthful good looks, this year he is celebrating 40 years at Petrinovich Pugh & Company. I met him in January of '83. I think I just heard ugh. I met him in January of '83 when he was a senior accountant, just 2 years in, and I was a brand new staff accountant. He has a BA from University of California, Santa Cruz in political science, and both a Bachelor of Science in Accounting and a Master's in Business Administration from San Jose State. He became a tax partner at PP&Co in 94, and he has worked on countless projects in those 40 years for clients in many industries, with a lot of work in real estate, implementing tax planning strategies, compensation planning, ISOs. He lectures extensively on these subjects, and an interesting tidbit about Tom: he's a real Renaissance man. He grew up in Santa Cruz, and in addition to his incredible accounting and tax talents, at one time he was a caricature artist on the beach boardwalk. So again, a real Renaissance man.
Tom, maybe going back to that.
I hope not. But in any event, Tom, it's a couple of housekeeping items. Again, please mute yourself. And if you have any questions, and there'll be plenty of time for questions at the end of our meeting, I would ask that you put them in the chat room, which is down at the bottom, and I'll be organizing these questions and asking them of Tom towards the end. So thank you again for coming, and Tom, it's up to all of you.
Thanks, Ron. Thanks very much, and welcome everyone. I hope you're safe and doing well in these crazy times. I'm tired of putting "stay safe" in all my emails, but it seems like that's the appropriate thing to do. So I've spoken to this group before. Last time was on the 2017 Tax Act. And boy, is this a different environment to give a presentation in. In those prior presentations, we were going over rules and laws, and there was some debate about rates, and there were some issues that people were upset about or happy about, but it didn't have the sense of urgency and importance that this does, for sure. I wanted to preface what I say by saying I've given this presentation a number of times now, and the situation is unbelievably fluid. The presentation I gave 3 weeks ago, 25% of it has changed in some way. The law is being written pretty much on the run. And I was afraid to look at the news today to see if anything that, from the Small Business Administration had changed even today. We are waiting for some guidance that's going to be pretty important. By the way, I'm going to apologize in advance. That terminology, awaiting guidance, sounds like a cop-out, and in a way it is. But frankly, as I said, the laws are being written on the run, and we're accountants in particular, and we pick holes in things, and there's uncertainties, there's inconsistencies. Frankly, the law as it was written and the way it's been deployed so far in terms of the payroll protection loans are quite different. So knowledge is always power, but you have to be flexible in your response. You have to be ready to go, and just keep all of those things in mind. As I said in the first slide, things are changing rapidly. It's accurate right now at 10:15. Who knows what's going to be going forward? So please keep track of that. We'll be giving more of these, but be aware of that. And then there's just the normal disclaimer. So we're going to be talking primarily about the CARES Act, which was the large federal response to the coronavirus epidemic that passed. Oh, it's been over a month and a half ago now. But there were some preliminary law changes also that are germane to what we're about to talk about. And so we'll be going over those too. When we go over the CARES Act, frankly, the issue that is of most importance to our clients and maybe people listening today is the payroll protection loan. And we'll be going through that, the evolution of it, and where we stand with it today. So some other issues outside of the CARES Act that are very important. When I first gave this presentation, we were headed into April 15th. For an accountant, that would usually be our witching hour, but they were kind enough to pass what we call the Accountants Act, which is that they delayed the due date of the tax returns and payments from April 15th to July 15th. The simple way to think about this is that anything that you had due on April 15th is now due on July 15th. That's not just the filing of a tax return, that's also the payment of the tax due, if there was one on the tax return, that is also deferred from April 15th to July 15th. Anything April 15th, now deferred to July 15th. So IRAs, which are typically due on April 15th, are also now extended to July 15th. So are HSA accounts. So that's very helpful. There will be no interest and penalties. To expand upon that, those of you who are self-employed tend to pay your taxes not with withholding, but with estimated tax payments. The first one was due on April 15th. That's been deferred to July 15th as well. That led to some issues when we were doing tax returns in that period, because we would send somebody a tax return and tell them that their first quarter estimate was due on July 15th, as I just said. Then we would tell them that their second estimate was due on June 15th, and they would think that we'd perhaps been hallucinating, and so they fixed that, and so now your June 15th voucher, the second one, is also extended to July 15th. So you have time in terms of managing cash flow, which is good. This was really helpful to us as we navigated this. I had a client tell me the other day, though, so I'm quarantined, I finally can get my taxes out on time. The one time I can get my taxes out on time, and I don't have to get them out on time, I have until July 15th. That's the way it goes. The deferment applies to all taxpayers, individuals, trusts, estates, corporations, other non-corporate filers, as well as those who pay self-employment tax. The IRS is going to temporarily accept scanned digital signatures. The IRS temporarily is allowing workers to send and receive documents by email. I'd like to note that there are any accountants anywhere nearby, and hearing this, they are howling because they know the IRS's level of technology is pretty Stone Age-ish. They use the Pony Express usually for their delivery. So I am actually doing some correspondence with email to the IRS. They are entering almost the 21st century in this regard. Some of the other filing deadlines have also been extended. Sales tax is now due, the form is due on July 31st. The Board of Equalization hasn't been as forthcoming as other agencies in terms of some of the changes they're allowing, but the extension is automatic unless you have a tax liability of over $1 million. There's a 12-month interest fee payment plan available if you owe less than $50,000 on sales tax. So when I first gave this presentation, it was before April 10th, and we were saying that the counties were not going to extend the property tax deadline. And in fact, Santa Clara County did not, but San Francisco County did. San Francisco County and San Mateo extended theirs to May 4th. San Jose's remained at April 10th, but they do have some penalty waivers if you are paying late. Finally, the economic impact payments.
Hey, Tom, I'm sorry to interrupt. This just came out last night. Governor Gavin Newsom has signed an executive order that will waive all penalties for property taxes through May of 2021 if you can prove, whatever that means, to the county assessor that the reason that you couldn't make your payment on time was because of COVID-19. I'm sure Larry Stone is thrilled.
Thanks, Ron. Ron will be, as I said, things are changing every minute, so Ron will be checking the news as I give this presentation because that's how fluid it is. The economic impact payments. This is a 500 billion portion of the 2 trillion stimulus package in the CARES Act. That's the infamous $2,400 check or $1,200 check that people are to receive or are waiting. There is a threshold on this one. If your income is between anything under $150,000 in income will be allowed to get this $2,400 payment, $1,200 if you're a single taxpayer. It phases out until if your income is over $198,000, this is adjusted gross income, you do not get the stimulus check. So the mechanics of it are that the payment that they're issuing right now is essentially an advance. It's a 2020 stimulus credit, but because they wanted to get it into the bloodstream of the economy, it's an advance. The advance was first going to be computed based on your 2019 tax return in terms of those numbers that I just said. If you haven't filed your 2019 tax return, they're going to look at your 2018 tax return. If for some reason you haven't filed a 2018 tax return, they're going to look at your Social Security records. If you file your tax returns and use automatic deposit and get submitted your routing and account numbers, they were the first ones to get this check. It went to them automatically. I think that's over a week and a half to 2 weeks ago. Those others were to be getting their checks over a period of time that could be as long as 20 weeks. I'm getting calls every day about where's my check. I am not writing the checks. Clients don't understand that sometimes, but there is a app. The IRS has an app. So let's just shake our heads in wonderment at that. Where's my stimulus check app? Go to irs.gov, and you can also, there's a portal there where you can input your routing number and your bank account to expedite the processing of the check. Now, a lot of what I'm saying throughout this presentation is the way it's designed and set up. That's the architecture. My clients tell me the reality is a little different in terms of gaining access, getting any kind of response in some of these. The app is fairly new, and I've actually heard some pretty good responses on the app. On the going to that portal and finding out what the status of your check is, they're getting things like numbers don't match. So they say, well, what do you mean? That must mean my account number doesn't match, and they check and it matches. Then they think, well, what does it mean? And they're calling me or others. And sometimes I think it means that somebody has, that there's an issue with a dependent or something on their tax return. We frankly don't know. And as I said, these checks are still coming out. So that's the stimulus check. And as I said, that should be coming out anytime from now until the next, well, now it'll be 16 weeks. As I said, the calculation is in advance. So when you do your 2020 tax return, you will be able to take this credit, but if you've already had the advance, you will just not get the credit. Remember, the credit is based on the numbers they have on hand. So that threshold number, that $198,000 threshold number, they will look to see if you make that threshold on your 2019 or 2018 return before they submit the check. Now, what happens if when you do your 2020 return and then your income, for some reason in this environment, soars and you no longer qualify for that credit that was advanced? You don't have to pay it back. And if you didn't qualify for the advance because your income, which is a more likely scenario in 2019, before all this was higher, and you therefore you had income over the $198,000, the question I've been getting is, well, am I out of luck? And the answer is no, you just have to wait until you file your 2020 tax return. It's an advance. So also before the CARES Act, they had what they call the Family First Coronavirus Response Act. This essentially is about sick leave and family leave. And again, when this came out, phone calls from clients saying, you know, it would be nice if the government understood it as an employer. I am under the kind of strain I've never experienced in my life, and now you're adding another burden. I have to add my sick leave and family leave. The purpose of this element of the law is not to have a net cash negative to the employer. It serves as a credit against their payroll taxes going forward. It's not supposed to be an outlier. There may be a timing issue that they addressed with some subsequent legislation, but the Family First Coronavirus Response Act went into effect on April 1st. There are two key provisions for employers. It expires on December 31st. To help employers pay for the sick leave and family leave, employer may claim a credit against their federal payroll taxes up to the amount paid to full and part-time workers. If the payments to employees exceed the payroll taxes, the employer will receive a refund. Qualified sick and family leave wages for which a payroll credit is allowed under the Act cannot be counted as wages if you enroll in the payroll protection loan program that I'm about to talk about. You can't double dip on these credits. So the sick leave is the first one we're going to talk about. The Sick Leave Act provides for up to 80 hours with a $5,110 per employee maximum of paid sick leave to private and public sector employees due to specific coronavirus-related situations. There are 6 instances where the sick leave applies. Note that the first 3 are about the employee. The last 3 are about the employees, typically the employee's dependent. Why is that important? Because the amount of the sick leave credit differs if it's for the employee, which is the 100%, as opposed to the dependent of the employee, where it would be 2/3. The 6 categories are: the employee is subject to state or local quarantine or isolation order related to COVID-19, yes. The employee has been advised by a healthcare provider to self-quarantine due to concerns related to the COVID. The employee has experienced symptoms of COVID-19 and seeking a medical diagnosis. The last 3 are about the employee's typical dependent. Is caring for an individual who is subject to isolation orders or has been advised by a healthcare provider to self-quarantine. The employee is caring for a son or daughter of such employee if the school or place of care of the son or daughter has been closed due to COVID-19. The 6th is this kind of amorphous one: the employees experience other substantially similar conditions specific to specified by Secretary of Health and Human Services. So those are the categories for the sick leave. That's a 2-week program. There's a total of 12 potential weeks if you blend the sick leave and the family leave. The family leave is a 10-week program. It's been expanded. It's capped at $10,000 total per recipient. Paid leave to care for a child or children because their care facility school is closed. The family leave is only in that regard. It is not for anything else. It's one reason only: unable to work or telework due to the needs or leave of a son or daughter. Just make that distinction. So as a hypothetical situation, if you, and I wrote down one here, and they base it on your pay rate, if you have a $24 pay rate and you're applying for sick and family leave, well, for the sick leave portion, that's the 2/3 number. So that's $16 an hour that person would receive. That's $128 a day. That's below the daily cap of $200, so you're okay. That would also equate to $6,400 in total. That's under the $10,000, so you're okay on that threshold too. And then that's the family leave. And then you probably blend the sick leave for the 2 weeks that is unpaid on the family leave program. So it's a blending of the two. Again, what came up when this first came out is my clients who are savvy said, you know, it's not supposed to hurt me. It's supposed to just help and I want to help my staff. I definitely want to do this, but I'm also trying to survive. And if you're telling me that this is something that's going to be a credit on my payroll tax return, and therefore I won't have to pay it, my payroll tax returns are every quarter. I'm in desperate situation here. How are they going to address that? So they've kind of closed that gap by saying that you could reduce your payroll deposit by the calculated amount of the credit, which is a much shorter time frame. And again, if that amount exceeds, the credit exceeds your actual required federal deposit, you're entitled to a refund. There's a Form 7200 that you can file, and we're told that it will quickly be processed and you will get a refund for that. I was just talking to our payroll administrator yesterday because we're now past April, and I'm curious to see, and my clients are saying, well, how is this going to look on that 941 form that we file for payroll? We haven't seen that form yet. I was shown what the deposit looks like, and there is a box that like ADP or somebody has, if they're a payroll provider, that has an offset to your deposit for the amount of the credit that you're entitled to. So those are the credits, and I just want to emphasize on that part that the intent is not to add a burden, but to provide a benefit to the employees without creating any cash outlay for the employer. So now we get into the assistance for employers in terms of loans. The Small Business Administration has been chosen to administer all this, and that leads to my first overview comment on this, which is that the Small Business Administration is not designed to process this level of activity. Just as an example, the Small Business Administration has 3,300 employees. They've been borrowing employees from other people, but 3,300 employees. There are 30 million small businesses in the United States. They typically process maybe 30,000 loans. So this is their dilemma. This was the dilemma that everybody found when we got into this, is that there was no infrastructure to execute these very fluid rules. So I am going to be giving the emergency disaster loan descriptions first, but be mindful, because I know that people who have tried to go through this process will be cynical about what I'm about to describe, because they were having difficulty just getting through to the SBA to discuss this, as opposed to even getting the loan. Things are loosening up a little bit on the PPL, on the disaster loan, not so much, but before I get into that, I want to give you the basic outlines of the disaster loan program. They're available between January 31st and December 31st of 2020. Again, it goes through the SBA, and there's a website there that we've got for you. By the way, we have a resource center on our website that Ron and Sarah Lynn have provided that is really, really sensational in terms of giving you more information, giving you forms to fill out if necessary, guidance. There's just a bunch of things there. This presentation will be there, sadly, but it's just a great thing to go to. We have a list of banks that are actually available to do that, although Sarah Lynn reminds me that that's an evolving thing too. It changes every day, but at least it's a starting point. The SVO also has a list of banks that are issuing these. Businesses are eligible for a one-time grant in this EIDL. I'm just going to call it the Disaster Loan Program of $10,000. You request that at the time of the application. It's a 4-page application. There's just one page there that has the application for this. The interesting thing about this is that you may not get the loan, but you can still get the grant, $10,000. I say these laws keep evolving. They changed one thing on this, which is the $10,000 is limited to $1,000 per employee. More businesses will qualify to these new rules. The approval requirements have been relaxed and payments can be deferred. The disaster loans obtained after January 31st can be refinanced with the proceeds of the payroll protection loan that I'm about to describe. The maximum available PPL is increased by the amount of the disaster loan, which then becomes subject to all the benefits of the PPL. The PPL has characteristics that are more beneficial, the most important being that it can be forgiven. The disaster loan is just like your basic small business loan that you normally get. The payroll protection loan is what it says. It's about something related to payroll. That's the focus. A disaster loan is the one you target if you're not a company that has a huge payroll. And when you see how the payroll protection loan is determined, you'll see that without a payroll, you can't get the loan. So then if you're in that category, you would pursue the disaster loan. The terms of the disaster loan are up to $2 million, 30-year max. Interest rate is 3.75 for business, 2.75 for nonprofits. There's an automatic 1-year deferment on repayment. So the first payment is not due for 1 full year. That's basically a free element. Interest is not accruing. That's a part of the EIDL program that, frankly, we didn't really grasp when this first started. The funds can be used to offset economic losses caused by the COVID-19 pandemic. this is really a working capital loan. The proceeds must be used for working capital such as fixed debt and payroll. The approval time is 30 to 45 days. There are no prepayment penalties. This one's not forgivable. It's a loan with very favorable terms in that period where you don't have to accrue or make any payments. Now, I'm giving you all the layout of the EIDL. I went on the website yesterday just to double check things, and this is what it said. It is currently unavailable and it is only available for agricultural workers. But Ron and I talked about this yesterday, and apparently that's not necessarily true. This is one of those fluid situations. There's never been an announcement that the EIDL is no longer available. So be vigilant, pursue it. A question that I will cover later, but might as well cover this now because I got asked it so much. Can I do the EIDL, the disaster loan, and the payroll protection loan? The answer is yes, you can. But you can't double dip. You can't use it for duplicative purposes. In other words, if the payroll protection loan is for payroll, you can't use a disaster loan for payroll. But otherwise, you could use it for other working capital needs that are not particularly encapsulated into the PPL. And with that, let's talk about the PPL. The Payroll Protection Program, some refer to it as the PPP or the PPL, referring to the loan itself. So I have this vision of when this came out, and now it's really been, if you look at the dates, it's been a month, I guess. The first tranche was $340 billion. So objective, fast injection of money into the business community. We are essentially involved in a self-induced coma. Businesses were not necessarily struggling, but were forced to struggle by virtue of the quarantine and the other provisions of that. So the idea was to try and preserve these companies and allow them to in turn preserve their payrolls by getting them capital to use primarily for payroll. But it was fast when they wrote it, and it was frankly a mess. And they started amending it right away. And they told the banks on a Monday that you need to be available to start doing it on a Friday. And the banks, we were talking to banks on that Wednesday, talking to small business bankers. They do this for a living, and they didn't know how it was going to be executed. So a number of the big honchos at the banks, the CEOs, had what I'm sure will be a movie at some point. They had a late night, all night meeting with Secretary of Treasury Mnuchin that Thursday night to try and figure out just what exactly they're getting themselves into, because they were saying, we're not doing it if we don't understand our exposure here. So they were given some level of security that they were protected. We believe that what they were told is that the government would actually even buy the loans if necessary. They clarified the compensation structure and the risk for the banks, which was important to them. And so they did unleash this payroll protection loan program. And it was, I guess you would call a success, because it immediately was not immediately, but quickly fully absorbed. That amount, that first $349 million went in less than 2 weeks. A lot of people at the beginning said $349 million is not going to cover the needs. Both Republicans and Democrats were saying that, and they were right. The problem with not doing it all at once is there was a gap between the first and second tranche where, of course, Congress had to get together and do their bit, and that got ugly, but they finally did do the second tranche of $310 billion, and now that's running out. On May 1st, they had already used $175 billion of the $310 billion. That was May 1st. At that speed, it may, and the way these things pile up, a lot of people that were in line for the first tranche immediately got into the second tranche. The amount of the loan, I should also add on this, the controversy with the program immediately became who's getting these loans. I'm going to describe who are the qualifying people, but a lot of people felt the bigger people, the people that had the connections with the banks, basically absorbed most of the capital before the small businesses that were supposedly the intended target could get it. The math was, to substantiate that, is 25% of that $349 billion first tranche went to companies with over $2 billion of a loan. We're told that the second tranche is much more evenly distributed, and they are enforcing some pretty onerous penalties for those who applied for the loan that didn't qualify for it. They're going to audit them, and so you need to, companies are actually considering paying back the loans that they got in that first tranche. Some already have, out of bad publicity for no other reason. The date to pay it back has been extended to May 10th. I believe that happened 2 days ago. If people decide that they didn't want the loan after all, or they don't like the terms, or they're just simply going to pay it back. So back to the second tranche, the amount is $310 billion. The amount of the loan can be up to the lesser of $10 million and be 2.5 times the average monthly payroll plus any disaster loan made between January 31st, 2020 and April 3rd. We said here at the very beginning, work with your payroll provider to determine your average monthly payroll costs. There were so many different explanations of what this payroll cost term was. This is what the accountants and the banks were flustered about. And we went through, because the law said that to determine what your payroll cost is, you add certain things, but then you subtract all your federal income tax withholding, your FICA. And they were like, well, that's going to be a complicated computation. Plus, it seems to defeat the purpose. In the end, they simplified it. This is important. If you're looking for a PPL loan, and if you've already done this, you know this, they simplified it. To determine the amount of loan you can take, you go to your 2019 total payroll from ADP, whatever your payroll source is. They know this, they will have this available. You divide that, because you need your average monthly payroll, you'll divide that number by 12 and multiply it times the 2.5 that I just mentioned to get the allowable loan that you qualify for. Now, I said the payroll costs include that amount from last year's 2019 payroll. There are a couple other things you get to add. Your group health insurance for 2019. You get to add a small amount of state and unemployment taxes to that figure. And then you have to subtract a couple of things. You have to subtract any amount of payroll to a certain individual that was over $100,000. But in the end, that calculation is greatly simplified from where it was at the beginning. If you're going for the loan, have your 2019 payroll records ready. Be able to know some of the numbers I just discussed, including your group health insurance. Submit with a very, pretty clean paperwork, and the loans are being processed. As I said, work with your payroll provider to determine your average monthly payroll cost. As I said earlier, you can apply for both a PPL and a disaster loan, provided the proceeds are not used for the same purpose. The disaster loan $10,000 advance that we previously discussed is excluded from that refi amount if you refi your disaster loan into the payroll protection loan. If a qualified disaster loan was used for payroll costs, your PPL must be used to refinance those same costs. The terms are remarkably forgivable. In fact, they are forgivable. It's a 1% interest rate. The loan term is 2 years. Payments for the remaining loan amounts after forgiveness will be deferred for 6 months. Interest will accrue during that 6-month period. You must use the loan proceeds for payroll costs, mortgage interest payments, rent, and utilities. Calculated payroll, the amount of salary paid to employees should be capped at $100,000 per employee, and that is just the salary of that person. So that's very similar to the determination of the payroll cost you use for the amount that you qualify for the loan. Self-employed income of general partners may be reported as a payroll cost. We didn't know that at the beginning of the law. That's clear now, so they don't have to do their own loans. They are just incorporated into the partnership's loan application. Their number is also limited to $100,000 on a PPP application filed on behalf of a partnership. So, as I said, forgiveness, the important part of the payroll protection program is if you use the loan for the proceeds that I just outlined, during the 8-week period, starting at the date that the loan funds, and we didn't know that at the beginning of the program. That was one of the unanswered questions. That's not necessarily a favorable definition, but we get asked that all the time. When does that 8-week period start? The day the loan funds. Then you have to start using the funds for those categories that I just described. This is the area where we have a desperate need for clarification from the Small Business Administration and the IRS about just what are some of the terms and how is it going to be executed. We mentioned that at least 75% of the proceeds must be used for payroll costs. We also note that the income, the loan, is not taxable income to the recipient. But we had a couple of questions right away. Payroll costs, 8-week covered period. Covered period defined as the day that you funded the loan. At 8 weeks, the clock starts ticking. What happens, and the definition of what qualifies are expenses incurred and payments made. Is that an inclusive determination or is it a separate? Can you accrue an expense and not pay it in that 8-week period and have it count? It says expenses accrued and payments made. Or do they mean that both of those categories must be met? Can I prepay my rent in that period and get it qualified because it wasn't accrued during that period, but it was paid during that period? And of course, we're accountants. We're going to definitely try to maximize all of these categories. And we need guidance on that because it's just not clear. They did say the mortgage payments are only allowable as qualified expenditures for payments that were due and paid during that period. So they did address mortgage payments, which leads us to believe maybe they will have a liberal interpretation of that. But that's a huge open item. One of the open items that I had was resolved last week, and we're hoping that they change this resolution, which is if you get the loan and you use the loan for those categories of expense, can you deduct the expenses? You used the loan to pay them. Answer as of last week is sadly no. They're saying that under a previous law, 265 is the code section, you cannot make a deducted expense that was essentially subsidized from outside your business. There's a big hoopla on that. Senator Grassley of Iowa, I think, is the one that's leading the charge to try and get that, to get them to reevaluate that. Most of the interpretations on these gray areas have been favorable in the past because, as Mnuchin said, the idea was to get money out there and to help companies survive, not to start being punitive. So those are two of the categories that were the most unclear. There was one rumor out there on this 75%, and yes, I'm talking about rumors now in the absence of guidance, which is that if you didn't use it for 75% of your payroll, did you have none of it forgiven? Which is not the way I ever read the law, but a lot of people do read it that way. So that would be a real problem for a lot of businesses who are just, because the way it was described and written that I'm understanding is the forgiveness that you have, if you use the funds for the appropriate expenses, that forgiveness will be reduced, not obliterated, to the extent that you don't meet the criteria that we just said. For instance, if it's not used for 75%, there will be a adjustment to the forgiveness, not a reduction to it, not a removal of it. That's maybe the most open issue that we're waiting on pins and needles from the Small Business Administration to figure out whether that is just a rumor. Who is eligible? Businesses with fewer than 500 employees or those larger than which meet applicable size standards for the industry. So if somebody asked me, well, wait a minute, I heard huge restaurant chains that have more than 500 employees qualified. They fell within these industries prescribed by the SBA. It includes sole proprietorships, independent contractors, and other self-employed people could apply for it. Questions that we got, how about nonprofits? There are a myriad of nonprofits. Do they qualify? Right now, only 501c3s, your normal church and typical nonprofit, and 501c19, which I believe are veteran organizations, currently qualify. So a club, for instance, would not qualify. We have a lot of club clients. I can tell you that they are actively and aggressively trying to get that change to widen the inclusion to more of the 501c groups. I mentioned the affiliate rule. It counts employees for all affiliated groups. Very broad determination of that. Do you have the power to control these other companies? Sole proprietorships, independent contractors, and eligible self-employed individuals can qualify. So about a week, we didn't understand how they would compute this for a sole proprietorship. We said the loan is determined based on your payroll. Well, if you're a Schedule C or you're a contractor, you're a sole proprietor, you don't have a payroll. Typically, it's just you. So how are they going to make that determination? So they shortcut this one completely and just said, use your 2019 tax return if you're self-employed. Go to your Schedule C on that. Self-employed people report their income on a Schedule C. Use your total number for the year 2019. Divide by 12, multiply times 2.5, and you get the maximum amount of the loan you can get. It's capped at $100,000, which means the total loan, when you do that math, is roughly $20,000 maximum loan the self-employed individual can get. When I've described that to some of my clients, they find that not worth pursuing, but that's the important description there. How do they compute the forgiveness of a loan to a self-employed individual? Ask that a lot. During the 8-week period, are they going to be measuring how you use the funds? No, they're going to go back to 2019 again. They're just going to do a mechanical calculation. Take eight weeks of the 52 weeks, 8 52nds of that amount, and that's the amount you will get forgiven. I think they're going to require you to provide some evidence that you were in business and using those funds for the business. And as I said, the amount at $20,000 is not substantial. And as typical, they did the calculation of the loan amount based on monthly amounts or annual amounts, and they based the forgiveness on monthly amounts. So if you had exactly the same amount, you would not still have all the loan forgiven, a flaw in the law. Back to the loan forgiveness, which I already talked about. It will be forgiven up to the proceeds of the loan for payments made during the 8-week period after issuance of the loan. So it says after issuance, it's when the money is in your account is when that starts. We didn't know that. So the forgiveness of non-payroll costs is limited to 25%. Those utility costs, those mortgage interest payments, the rent, those are limited 25%. This is a payroll protection law. The feds expect 75% of these funds will be used to maintain company employment levels and payroll costs. I've gone through already some of the open areas, but as I said here, more details on loan forgiveness to be released. So, real world discussion. I have a client that's a restaurant. Like everybody, they heard about this. They're desperate. They want to keep their company afloat, but the business is closed. They want to keep their employees. So they saw this as an attractive venue. They pursued it. They had a relationship with the bank. They got the loan. They weren't quite sure at that point when the, quote, the covered period began. And now they're told, I've got my loan, say $400,000, to pay payroll primarily, 75%, but I'm not open. I can't open, and things are opening up slowly, but all I'm doing is takeout right now. I don't need these employees. I need that payroll, that period to either be extended or to start later or to make it, one of the restaurant associations is pleading with the government to reduce that 75% to 50%, because otherwise they're not going to hit that 75% threshold. And then this reason they did it, one of the large reasons, a forgivable loan, it will just become more debt on an already struggling company, which was not their design. I know people that are listening to this are shaking their heads. This is where we're in the dilemma we're in right now. We need to monitor it, see if they change some of these percentages to help some of these companies in that dilemma. But in some cases, even with this, an employee may just go on unemployment. They've expanded unemployment benefits, added $600 potentially, and they'd rather go on unemployment. Now, anybody that's gone through that process can tell you how difficult it is to even get through to the Employment Development Department for that, but at least that's something that needs to be considered. The IRS recently released a notice that disallows any deductions for payroll costs, mortgage interest, rent, and utility expenses paid with the proceeds of a PP loan if the loan is forgiven. Already covered that. That's the one that I was concerned about, and unfortunately right now they're saying, the IRS is saying this treatment provides a double tax benefit because the PPL loan forgiveness is not taxable income. That's the taxable income element. But now allowing the deduction really is a significant blow to those people that got the loan forgiveness. And I am surprised. I thought that given the spirit of the law that they would allow you to also deduct those payments, even though you can see the point, you didn't actually pay it, you used loan proceeds to do it, but it just by definition reduced the overall net after-tax benefit of the loan. Purpose of the loan is to keep these companies alive. Who can the lenders be? All existing SBA certified lenders will be given delegated authority to speedily process PP loans. They weren't speedily being processed at the beginning, but frankly, they started to get faster. The Treasury Secretary is authorized to approve new lenders to make loans under the 7(a) programs. Contact your bank or lending institution to determine your eligibility and begin the application process. Have your payroll records ready from 2019. Know what your health group insurance was. have your ducks in a row when you go in for this, and it can be a process that can be sped up. So that's the Payroll Protection Program, probably the most important element of the law, and unfortunately the one that has the most open issues in it. More on it, lessons learned. Ask your bank what info they want and how they want it. Do what they say. They're on your side typically. They're trying to get this thing executed. They have their own process. They're being given a lot of leeway in terms of how they process it, but they also have exposure, and so they're going to want you to follow their guidance. That $100,000 compensation limitation does not include health insurance or pension contributions. That was not clear at the outset of the law. If they request a calculation of how the funds are to be used, be sure that 75% is used for payroll. That's what we discussed earlier. There is still uncertainty surrounding the forgiveness calculation, and we await guidance. I've gone through the permutations myself about 800 times to try and get a favorable and non-favorable way to compute this. It's not too late to apply. One of the reasons it's not too late to apply, I did listen to the news a little bit this morning, and Speaker Pelosi is anxious to get the third stage going. This is an interesting little dynamic that's been going on throughout this, which is that the Senate, McConnell, has been resistant and looking concerned about impacts on debt. We had a almost $23 trillion debt before this all happened. So now it's probably 26 to 27 trillion. We used to get some comfort by knowing that our gross national product was close, the GDP was close to that amount of the debt, be like a house versus your home loan. But now the GDP is estimated to potentially shockingly go down as much as a third in the next quarter. So now we have a disproportionate balance there. So frankly, the one that's been the White House with Secretary Mnuchin seems to have been historically the one that basically gets the thing across the goal line. He has been more anxious to get it done. So he has been anxious to do it. And Lawrence Kudlow, his leading economic advisor on Sunday, Trump's leading economic advisor on Sunday, said that he said he's concerned. It looks like they're going to have to go to the well again. So there's probably going to be yet another PPL loan provision, in addition to this $600+ billion we've already seen. So it's not too late to apply. The people that were late to apply for the first tranche were the first ones to get in to the second tranche. If I haven't said it already, it's first come, first serve. Okay, other additional COVID-19 resources.
Hey, Tommy,
yes.
Can I jump in? And these resources will be available on the internet. On our website. I think if you moved into some of the tax benefits of the program, maybe that would be beneficial. Is that okay?
You got it. We got to keep moving too. I get it, but these are things to look at. So more resources. We're resource friendly here. So the employee retention credit. Remember I talked about the family leave and the sick leave as credits that offset your payroll deposit. There's a third one. It's called the employee retention credit. First thing to note is you can't do the employee retention credit and also be enrolled in the payroll protection loan program. Those wages that are already being used for that program cannot be used for the employee retention program. But as people started having some difficulty with the payroll protection program and being concerned now about this forgiveness element, they're starting to focus a little bit more on this employee retention credit. The CARES Act allows a 1-year credit against the 6.2% employer portion of Social Security payroll taxes for any employer forced to suspend or close operations due to COVID-19, provided the employer continues to pay employees during the shutdown. Businesses that do remain, that's the shutdown portion. The second portion is businesses that remain open for which gross receipts during any quarter in 2020 were less than 50% of what they were for the same quarter in 2019. They will also be eligible to accredit each quarter until their sales reach $80,000 compared to the prior quarter. The limitation on the credit is as follows. You take the qualified wages for each employee and they may not exceed $10,000. The credit is 50% of qualified wages, so there's a maximum credit of $5,000 per employee, but that could add up. The credit is refundable. If it exceeds your payroll tax liability, it's refundable. You get the difference. Any wages used to calculate the payroll tax credit for the Expanded Family Leave Act. I mentioned that you can't be in the PPL program, but you can't use wages that you've already used to trigger the family leave credit or the sick leave credit to also get the retention credit. Makes sense. And as I said earlier, the retention credit is not available for employers who take out a payroll protection loan. So the employee retention credit is also out there as something you may want to explore. It will also, this update is what I described earlier, which was the mechanics of the credit, which is to say, instead of having to be offset on your payroll tax return and have to wait 3 months, it is an offset on your payroll tax deposit. So that amount of the family leave and the sick leave credit, and now the retention credit can be calculated and used to offset your federal tax deposit. And if it exceeds that deposit, you file that form $7,200, not dollars, and hopefully get that difference back quickly. The deferred payment of employer payroll tax is one other thing we just described. The employer's share of the 6.2% Social Security tax that would otherwise be due from March 27th to December 31st. People ask me, how long does this go in play? It's till December 31st. May be paid over time, may be paid 50% on December 31st, 2021, and the remainder can be deferred all the way to December 31st, 2022. This is the employer's share of Social Security tax. Our firm, I always like to use our own experience. Of course, we were focused on the payroll protection loan. We weren't as focused on the retention loan. And then we started to look at this and say, well, wait a minute, this is also something we need to really be mindful of. This is a big number that could potentially be deferred in terms of having to pay it. So you have the sick leave credit, you have the family leave credit, you have the employee retention credit that reduce your payroll tax deposits, and you have the deferral on the excess that you may owe on the that can be deferred for 2 years. You can see why the federal government and the state of California are going to be completely out of money probably yesterday. But we need to know the rules. So some other tax laws that were changed or modified to help taxpayers that are suffering through the coronavirus. Did a little history. In 2017, I gave a presentation to the Capital Connections Group and to others talking about new, mostly positive tax law changes in the 2017 Tax Act. There were 3 or 4 that actually weren't favorable for business. There was one for the net operating losses. There was one that limited the deductibility of interest. And there was one about the deductibility of depreciation on leasehold improvements. They were unfavorable. I think wisely, and I was surprised, but the people that passed the original CARES Act took the time to fix that and threw these provisions in as well. The first one is the net operating loss. The Tax Cut Act, the one I just described, eliminated the ability of taxpayers, businesses, to carry back net operating losses and limited the carry forward to 80% of taxable income. In the past, we were eligible to carry it back 3 years and then carry it forward 20 years. But they removed all that and said you could no longer carry back net operating losses at all. So the previous laws, if you were having a bad year, you could file quickly within a year a form, 1139 I think it is, you file the form and are quickly able to get taxes back that you'd paid in prior years. That's the whole purpose of a net operating loss carryback. The 17 Act had gotten rid of that availability. This CARES Act reintroduced it. Now you can carry it back. And you can also carry it forward without the 80% limitation. The CARES Act allows 2018, 2019, and 2020 NOLs to be carried back up to 5 years. Alternatively, the taxpayer may carry the NOLs forward 2019 and 2020 without the 80% limitation. So you can get working right now on amending the 2018 and 2019 returns to carry back those NOLs and get dollars that you paid for earlier, potentially more profitable years. Qualified improvement property. This is improvements that you do in your business. You're a restaurant. We have clients that spend hundreds and hundreds of thousands of dollars on leasehold improvements in their property. Retail, restaurants. other businesses. The law for qualified improvement property has evolved over the years for us as accountants. They first said that they would have these three categories: restaurants, retail, and other. And on those categories, you'd be allowed different levels of depreciation and accelerated depreciation depending upon which category you were in. A couple of years ago, they decided to simplify it. And they said everything's just going to be qualified improvement property. Why is that important? Because previous to that, if you did, say, a $2 million improvement on a restaurant, the old law would be that you would have to depreciate that over 39 years. Take forever to recapture and deduct the amount of that payment. With the change to make qualified improvement property have more favorable depreciation terms, you could depreciate it over 15 years rather than 39. But more importantly than that, it would qualify for something we call bonus depreciation, which used to be 50% of the expense could be depreciated in the first year. And then they liberalized that rule and said you could do 100% bonus depreciation. So it was potentially a $2 million deduction for that restaurant, the intent of the law in 2017. They screwed up. They forgot to change the life when they wrote the law. These things happen. So in point of fact, it made it worse for qualified improvement property, and all of those improvements were now being required to be depreciated over 39.5 years. Disaster. And the only remedy was a law change, getting the Democrats and Republicans together to pass a law. Good luck. Well, with this law, the CARES Act, they fixed the qualified improvement property issue. The CARES Act makes technical corrections to the act, corrects the mistake, making it 15-year property instead of 39-year property, which is important, but more importantly, it makes it available for the 100% bonus depreciation. Also, the change is retroactive to 2018, so be able to file amended returns to claim the refund. Another reason to file an amended return, and maybe you want to combine all of these things into an amended return. So that's huge and potentially very beneficial to capital-intensive companies. Another damaging element of the 2017 Act is the limitation on interest deductions for businesses. The 2017 Act limited business interest expenses to 30% of adjusted taxable income and forced you to carry over the excess to subsequent years. A real estate enterprise where mortgage interest is a significant portion of their income, it would be more than 30%. We're hammered by this. The CARES Act increases that limit to 50% of adjusted taxable income. Huge relief there. In 2020, a lot of businesses are going to be in a loss situation, so that won't necessarily help them. So they got creative and they said to help even out business income in 2019 with probable business losses in 2020, you can use your 2019 income to calculate your 2020 interest expense. That would likely generate an NOL, and then you can use that NOL provision that allows you to carry it back to do that. It's huge. 3 reasons to potentially amend your tax return and get these benefits. Partnerships have difficulties amending their tax returns. There's partners that can't all amend their returns. And there was an act a couple of years ago that essentially insisted that all changes at the partnership happen at the partnership level. They are allowing partnerships to go back and do some amendments just for this provision. So that's important. So there's a lot of relief in these 3 areas. Before I get to the other questions, I do want to add one other thing. This is a little deeper dive, but I've been asked it a lot, so maybe not. That 30% interest limitation I discussed, there was a safe harbor for businesses like real estate that said, we'll allow you to deduct more than 30% of your interest, but there's a trade-off. If you do that, you have to use the 39-year depreciation rather than a faster depreciation amount. So those people made that election last year, and now they're like, why did I do that? Because I've already started that depreciation process on a slower depreciation because I wanted the mortgage interest. Now they're allowing me to deduct it, but I've already made the decision. They're allowing people in that scenario to go back and quickly, there's a time frame, I think it's through September, I'm not mistaken, to fix that and to get that more liberal depreciation and the more liberal interest deduction taken. So a lot of information, As I said, guidance needed, particularly under PPL, but keep your eye on all of this stuff. I hope I didn't go on too long. I've lost track of the clock, Ron. So if there's any
Tom,
questions, let her rip.
Only about 3 minutes over. There is one question I think that really you didn't handle, and that is, Tom, if a business was previously ineligible for a PPL, becomes or it was unavailable to them because it ran out of money, becomes eligible under the third tranche, would that business be ineligible if they took advantage of the employee retention credit previously? In other words, the money's out. Let me use the employee retention credit while it's there. Oh my gosh, there's more money. What do I do now? And then we'll wrap up. Why don't you please just advance it to the slide with your contact information while we're sitting here now.
I wasn't going to do that, Ron. My picture's on that one.
No, I know, Tom. All the more reason to.
That question on the retention credit, I'm sure what they're going to do, this is what I listed out a bunch of them. I think what they're going to do is adjust the loan amount perhaps, as they've done on some other things, but they're not going to unring the bell on the retention credits you already qualified for. You can't change. I mean, I think that's a done deal. I think you're fine. I think you still qualify for the PPL, but I think they will adjust the PPL for the amount of credit that you've received to date. That's me talking because that's one of the issues that was listed as something they're going to have to resolve. Believe it or not, when they did the payroll protection loan, they weren't anticipating tranches of it. So this was ground that we weren't expecting, but thanks for the question.
Any other questions for anybody? Put them in the chat box. If not, Tom, if you can move it to the lovely photograph of you.
There it is.
And yes. Tom's contact information is available down below. These slides will be on our website. Give Sarah Lynn about 24 hours to do so. Tom's available for questions. Many of you know me. I can put you in touch with Tom directly, make an introduction if you'd like. Tommy, thank you so much for all your hard work and time. And thank you to all the participants. Look for more Capital Connections type of events online coming to a computer near you soon. Thanks again.
Thanks, Ron.
Thanks, Ron.
Good job.